Hey everyone, welcome back. I'm Jeremy Szafron. Well, there's a major disconnect in the markets today, and the question for investors is quite simple here. Where's the opportunity? Now, we have a physical commodity market that's signaling a major supply squeeze. Just this morning, Freeport declared force majeure at giant Grasberg copper mine, sending prices surging over 3.5%. Now, this comes as platinum, the year's top performance with nearly 70% gain, sees its future market cap in a steep backward action, a clear sign of physical tightness. And at the same time, we also get some U.S. data out of the economy, and it's sending confusing signals. We just saw the strongest new home sales print in 3 years, but it was fueled by deep discounts from the builders. So, how do you make money in this trade? Where is it? Do you follow the warning signs from the physical market, or do you bet on the strength in the domestic economy? Here to help us find the opportunity in this divergence is Ole Hansen, head of commodity strategy at Saxo Bank, and a strategist who's been well ahead of the curve of many of today's key market moves. Great to see you, Ole. Thanks for being with us.
Thank you very much for having me, Jeremy.
Okay, we got lots to get to. We talked about it, and I want to quickly touch base on that U.S. macro picture before we get into commodities while you're here, Ole, because, you know, we saw that big 20% surge in home sales, but as you kind of claw back the data, it was driven by heavy incentives, more than double of what was normal. What does the one data point tell you about, you know, the health of the U.S. consumer, and does it factor into any global commodity outlooks here?
Not at this point. I think we obviously getting quite a lot of mixed signals right now out of the economic data, but broadly it looks like we're still heading for some kind of a slowdown. The impact of the tariffs are only really starting to play its part now, and I believe that still will weigh more on the market than this kind of number today, which I believe is a blip for now. Obviously, we are now starting to see the rate cutting process in the U.S. The question is really how much they can cut at this point where inflation remains rather sticky. So that will be a telling sign for how the housing market is going to fare. But I think the consumers in the U.S., just like anywhere else, is pretty strong up right now. Inflation has eaten into their available income. Prices seems to be going up, even though the inflation data shows that it's relatively modest, and that just obviously raised the question how much that can translate into a fresh building boom, even if rates come down.
Yeah, it makes you wonder how much, you know, weight you can really put on one subsidized data point here. Let's get to this big story. Freeport just announced this force majeure over at Grasberg. Now, you were quoted from this breaking story this morning in Bloomberg saying, quote, talking a little bit about how it shows how little it takes to tighten up the market. Let's talk about this. How significant is this disruption, especially as it comes on top of the simultaneously shutdown of Hudbay, right there, their Constancia mine in Peru?
Yeah, and I think you also have to add the Codelco run mine in Chile, where we had a mine collapse more than a month ago. They're still struggling to get back up and running. So basically, we have the two biggest mining operations in the world temporarily shutting production, and that is simply not what the market something the market can take at this point in time. We have seen obviously a massive flow of coppers going into the US in recent months ahead of the tariffs, which then didn't materialize, and that means there is a bit of a skewness right now in where copper is actually stored compared to where it may actually be needed, and I think that's helping to underline this the strength in the market, or the tightness in the market. And it's obviously I've always been watching high grade copper because it's easy to trade, but unfortunately right now we have to focus on the LME copper price in London, because that during this tariff squeeze in New York, which obviously ended up being unfounded, the London price was actually behaving very well and didn't do much in terms of range. And what we've seen today is it has broken higher above. I'm just looking down on my screen. 10,160 was a level where we've been rejected 4 times, and as we speak now, we're trading above 10,300. So it looks like today we have a technical break to the upside, which potentially could signal further strength. But obviously, some of that depends on this tightness coming in from these mine disruptions.
Yeah, and you mentioned it. I mean, get into a little bit about how big this disruption is. I mean, as you mentioned, I think Freeport's the second largest mine for copper. I mean, this is some large numbers if it is sustainable.
if it is sustained, then there will be tightness, no doubt about it, because we've seen a copper market which has held up very well. We have to remember that just going back a few years, the main demand for copper was towards housing, especially in China. Housing there has slowed down, but instead the alternative or new renewable energies has really taken over. The electrification, which is ongoing, or really has been rolled out very rapidly in China, where we probably a little bit behind around the world and elsewhere. That is picking up pace, and that's basically picking up the slack that in copper demand that otherwise could have been expected with the tariff related worries about growth and so on. So I think we're staring into a future where the copper demand will continue to be strong, and we simply need to see whether the miners can keep up and supply the copper that's required. Otherwise, obviously, they need to find it through scrap. But generally, I think at current levels, we are not high enough really to incentivize a strong push towards further excavation and further mining projects being started. So I see the long-term outlook as being positive for the copper market.
And on this, this price action on the 3.5% that we're seeing on the jump today, I mean, just yesterday, we were talking about a significant visible surplus in LME and COMEX copper inventories. So is this, price surge a sustainable kind of fundamental repricing based on new long-term supply deficit? Or do you see it as kind of that short-term speculative reaction? As you mentioned, buy first before asking questions.
Well, the break now has triggered a technical buy reaction. There's no doubt that hedge funds around the world who's following momentum and following technical strategies, they will be buying into this breakout. So obviously, the next couple of days will be quite crucial to see whether this breakout sticks. So I think quite a lot of it is ascribed to speculative trading from a technical perspective. And now in the coming days, depending on how long this disruption will last, then we'll see whether this is the breakout or whether it's just another attempt to take it higher before we basically then pause again. So the next few days will be very important there.
Yeah. Okay. Well, let's turn to gold. I mean, obviously, we've been talking about it. It's been hitting record after record, and it's been kind of consolidating here around 37.50, but it's just below that level now. Last time I checked, it was just 37.30. Do you see this as a healthy pause before the next leg up? What's your outlook here?
Corrections in gold during the last 3 years have always been healthy because it has given investors a little bit of an opportunity to catch up and just to check the strength of the market, because it's always during corrections you get a proper feeling for the strength in the market, because when it goes up, it's just a lot of buying the next high, momentum buying that comes in. But when it starts to retrace, then you have to really to show your hand, and we've seen that now on many occasions for the past 3 years that any setback has been very shallow. But it's also very interesting, actually, that gold, despite of all this surge we've seen, it's trading extremely technical. We trade in the range. We broke up, hit a record high back in April. Since then, we just settled into a range that narrowed on a weekly basis. We basically created a wedge. And if you look at some of the charts I put out on X, the breakout happened on September 1st. And when I looked at that range, and I basically targeted the move up to just below 3,800, and I think we stopped at 3,790 yesterday. If that's being added now, if you look for retracement levels, then potentially this move could take us down to close to the 3,600. And we have to remember, even though that sounds as quite dramatic, it's just a reflection of how far this market has traveled, that corrections can be relatively deep without really hurting the overall bullish setup.
Yeah, year to date. I mean, the strength has been absolutely incredible. And I got to ask you, I mean, you with what you do over there at Saxo, you're talking to institutions all the time. I mean, the World Gold Council is showing ETF flows are finally turning positive this year. Are you seeing signs that large institutional players are still fundamentally underweight gold in their portfolios?
I believe they certainly are, and I think the ETF flows tells a very big story there, and it's interesting to see that when interest rates started to go up back in 22 in order to combat inflation, that's when ETF flows started to be reduced. We saw net selling for a couple of years. And actually during that time, gold was rising simply because whenever an asset manager was selling out of his gold because he couldn't hold it because the funding cost was getting too expensive, then the central banks were stepping in, picking it up. And now it seems like both central banks and asset managers are buying it at the same time. I would add a small caution there to the central bank demand, because we have to remember that the value of the central bank holdings now are exceeding in some cases the value of the bond portfolio, simply because gold has rallied as hard as it has. That basically means that the need to accumulate more gold at this point, given the current value of gold, may start to see the demand from the central bank slow down a bit. But if interest rates continue to come down, if you continue to worry about the outlook for the U.S. economy, about the Fed independence, about the debt situation, then bits are likely still to come into this market.
Yeah, more fuel on the fire, as they call it. Okay, well, let's talk about the physical market for gold then, because we've seen reports of the premium on the Shanghai Gold Exchange remaining persistently high over London prices. Do you think this is a signal that physical demand in Asia is the true driver of this market and that the West is just playing catch up?
I think if you take investors in China together with the People's Bank of China, then we obviously have quite a strong force in the market, at least for the past few years, and it just highlights the demand for gold in China remains very firm. Especially the Chinese investors are not poor people, but they used to put their money into properties, into a second or third home. I think that idea has kind of flattened out a bit, and that basically means there's money that needs to be invested. The stock market has obviously benefited greatly recently, quite a strong move there, but at the same time there's also money going into the gold market. Chinese speculators, just like anywhere else in the world, tend to be very speculative, and that basically means that this flow may ebb and flow, come and go. But you're absolutely right. The premiums right now are quite elevated, indicating there is a strong demand from Asia underpinning these prices. And now that we see perhaps a small correction, once again we'll have to gauge the strength of that demand.
Yeah, interesting point there about, their second or third homes, with the market obviously collapsing in Asia, where they're putting some of that capital. I want to turn to a major geopolitical story moving kind of the gold market as well. According to this report by Bloomberg, I think just yesterday, China's central bank is actively courting foreign nations to buy and store their gold reserves in Shanghai, creating kind of an alternative to these vaults in London and New York. Do you see this happening? I mean, is this a signal that we're moving towards a multipolar monetary system where countries can effectively choose a side for storing their most critical assets?
Well, we are increasingly seeing three major centers, or probably even more, for gold storage, and Shanghai is most certainly one of them, and rightfully so, because obviously they have been the major buyer of gold in recent years, and they hold an increased amount, meaning that they hold some weight in this market. So the question is still really how do you deal with the currency? It's not a free floating currency. How is that being achieved? How is that being perceived? Obviously, if you have a large amount of trade with China, you may just want to stay in renminbi. But I think that potentially could still be a bit of a drag. But again, they're looking towards their friends, especially in Asia, and with that in mind, they're obviously trading a lot with each other. So that potentially could mean that they could circumvent the dollar by focusing on the renminbi instead of dollars.
Yeah, I wonder. I mean, realistically, though, London's dominance is built on that deep, unparalleled liquidity of the LBMA system, as you know. I mean, the pool of central banks willing to forego that liquidity and legal, precedent to store gold in Hong Kong or Shanghai, it seems limited to nations already facing sanctions or, China's political orbit here. I mean, is this less of a global threat to the dollar's dominance and more of a niche service for a few select countries?
I think it's still a niche service. There would be more would have to happen for the dollar really to be threatened. Obviously, we are seeing the tariff war. We are seeing the potential reduction in global trade. That means the demand for dollars may go down over time, and that will obviously lower the demand for dollars in general and the need to store dollars. But we're not there yet in by any means.
Yeah, we got to talk platinums. Obviously, that's one of the reasons we were chatting here today. But before we do that, let's talk silver, because before coming to air here, Ole, you and I were chatting, and you said, Silver and platinum, I mean, some pretty darn good upside here. We've seen silver take a little correction today, just below $44. What's your outlook? What's your thought on the market?
Well, if you were bullish on gold, you have to talk about $50 in silver, the record high from 2011. We've had a phenomenal run up in silver, and for a change, we actually did break some key levels without going back down, testing them, and actually break below key levels, which is that has been the story for silver for quite some time. That whenever it had a breakout, it never really gave the buyer any peace of mind, because we saw corrections that quite often took it back below these breakout levels, something that we haven't seen in gold. And that's why gold is, I mean, nothing is easy in this world, but gold, from that perspective, if you are buying breakouts and you're holding on, then gold has really not offered any headache since 22 almost. Silver is providing a lot of headache, and but just recently in the last few months, the breakout we saw, I believe, was 35. When we took that out, we didn't even get close in terms of getting back down to correct or to test that breakout. That was quite a strong signal. So silver is in a good place right now. We just, as usual, have to remind ourselves it is gold on steroids. So basically meaning any corrections in gold will be multiplied in silver. But looking at the industrial part of silver demand, that one looks healthy. Supply is tight. We are seeing a global supply deficit for a number of years now. That basically means that increased demand from investors towards ETFs, besides the industrial demand, will continue to lower the above ground level of stored silver, and that will help to tighten the market and help underpin prices. And I think we're seeing part of that already unfolding. So I'm a long-term bull on silver. Probably like it even a bit more than gold, because it tends to be allowed to run a bit faster than what we're seeing in gold.
Yeah, and I mean, even if industrial users attempt to kind of thrift, has the monetary demand for silver now become the dominant driver? I mean, with record inflows into silver ETFs, and mints are apparently struggling to kind of meet demand for physical coins. I mean, is it possible that the investment narrative for silver is that undervalued gold story? You know, it can now maybe overwhelm any marginal changes in the industrial consumption?
That could potentially happen, and I think it just boils down to the fact that silver is cheaper. So buying a silver coin doesn't fleece you too much, whereas silver at almost $4,000 an ounce, not quite, but that it is a tall order. Silver is still something that appeals to the broader public and investors who just simply who've heard enough stories about gold and silver going up that they want to get involved. One thing trying to buy a gold coin, and another thing is to get hold of silver, and that helps. Yeah. That's part of the tightening story, but the ETF flows obviously is the big one in terms of hoovering supply out of the market and thereby helping to tighten it up.
Yeah, speaking of supply, let's start with the star performer here, platinum. I mean, its futures curve is in a steep backwardation, and we now have data showing a 660% year-over-year surge in physical bar and coin investment. Is the price action we're seeing primarily a story of a fundamental physical squeeze?
Platinum is found itself in an incredible sweet spot back in May. Yeah. If we look at the chart, we've basically been in a downtrend for now. I can't even remember whether it was 11 or 15 years, but it's a long time. We were just in a downtrend since we hit those peaks. I believe it was back in 2011, and then we actually almost had a decade. Even though we were in a downtrend, it was a downtrending range area where we basically more or less didn't do anything for a decade. Simply because the focus was primarily on the automobile industry and the demand deriving from that. Jewelry demand was not really something that came but went again. And then suddenly we came to the point where, with gold continuing to rally, investors or traders around and jewelers around the world look, well, hang on, this is just getting a little bit ridiculous. Anything else we can substitute and look at instead? And then obviously platinum was just a screaming buy at that point. We had a very bullish London Platinum Week back in, I believe it was late April or May, and that basically set the tone, because once again we were reminded that this market is in a supply deficit for the fourth year running. demand is supply is not easy to increase. It's primarily out of South Africa, and if we are seeing increased demand, not only from the industrial side, which is part of the high tech, the high tech future, but also from jewelry, then obviously we have a perfect storm. And basically within the next 2 months, platinum rallied 50%. Again, using retracement levels, technical analysis, I was looking for. Well, I wasn't, but it basically corrected the 0.382, which is a weak Fibonacci retracement of that whole rally. That's exactly where we found support. And early this week we broke higher to made a new high, the highest level I believe since 2011, and that basically means that it's once again on the run. But it needs gold at this point in time, I think, to make further progress. So if we are seeing a correction in gold, then platinum probably will take a pause as well. But its relative cheapness is a strong argument for platinum, combined with the physical tightness that we're seeing.
Okay, Ole, let's talk about the gold-platinum spread, because for decades, platinum traded at a significant premium to gold. And I mean, today, it's still got a discount of more than $2,200 an ounce. Is this a permanent structural shift, or do you see a path for this historic relationship to kind of mean revert? I mean, what would it be the catalyst for platinum to trade at a premium to gold again?
First of all, the continued strong demand for tangible assets, for metals, whether it's precious or industrial, in a world where you worry about the level of the dollar, worry about other asset classes, then and where tangible assets will play an increased part of investors' portfolios. If that turns out to be the case, then investors will look at this relative cheapness to gold, and I think perhaps with that in mind. It is probably a little bit too far to say it's a generational trade, but when you have something that moves 50% in a relatively short period of time, consolidate and then wants to move higher once again, it does indicate that demand is still out there. And I think if you simply combining the strong demand with metals or markets where supply is tight, then obviously you have the recipe for higher prices, and I think platinum is a strong candidate for that trade.
Yeah, interesting. I want to talk to you about the rest of the PGM complex, because for years, I mean, the story was palladium's dominance in gasoline auto catalysts, as you know. I mean, kind of leading to a massive price premium over platinum that peaked above $1,500. That spread has completely collapsed. I mean, do you see a structural substitution trend of cheaper platinum replacing palladium in gasoline engines as a key driver for platinum demand?
That was the initial trigger in the past few years. Simply, palladium became too expensive relative to platinum, and the substitution is not something that decided overnight. You get to work one day and then you decide today we're going to use palladium instead of platinum, vice versa. This takes years. So once that trend is in motion, then it will continue. Even though for a while now we've been seeing platinum regain its crown versus palladium, but I think from an investment perspective, palladium is a tough one because it's just simply too small. The interest there is relatively small. Again, jewelry-wise, I haven't heard much about palladium rings. So I think the investment side of the equation is primarily focusing on platinum, and I think that's really where that's where we're seeing the major catalyst, and also towards some of the new technologies where again it seems like it's palladium or platinum that is the one that's sought.
Yeah, see, it feels like that EV narrative, it's kind of out the window now. It feels like it's more on the hybrid.
Yeah, that's an interesting point, and I think that's one that's potentially another positive driver, because probably one of the reasons why platinum has been in the doghouse for a number of years was simply the rapid rollout of EVs and the thought that combustion engines were going to be heading towards the graveyards, and there would be no demand for that in years to come. And we are seeing now that the EV rollout is slowing. The hybrids are coming back. Hybrids tend to be gasoline. That tends to be platinum. So generally, it seems like the automobile industry, the demand that perhaps was forecasted to be slowing in coming years may end up being more robust than previously thought, and that obviously add another dimension in terms of demand.
Okay, well, let's look at the other side of the complex. I mean, crude oil is at $65 a barrel, and it seems to be pricing in a significant global slowdown, a view supported by the weak Baltic Dry Index. But how do you kind of, if we zoom out, Ole, we've talked about this. Obviously, we know that it's cyclical, but how do you reconcile that signal from the physical economy with the all-time highs in the S&P 500 right now?
Oh, that's a good question. The oil market seems to be living on its own planet right now, basically dislocated from the rest of the world, and it's. I think it's mostly just simply due to fundamental developments inside the oil market. We all know that OPEC Plus has been adding barrels on a regular basis now for the best part of the last year. What we also know is that not all of these barrels have yet reached the market. Some producers are struggling to meet their new higher targets. Some are holding back because they've been overproducing in the past, so they need to wait. And so it really leaves only a few out of those 8 nations that are raising production that has actually been able to do it. And now we're seeing the Russia situation, and that's probably why we once again trading close to $70 here in Brent. Still stuck in a wide $5 range, or actually let's call it a very narrow $5 range. We've been now stuck in that for quite a while now, but it's making an attempt to the upside, and that is the heated global geopolitical situation that we have now with Trump suddenly seem to be a bit more friendly towards Ukraine, probably realizing that Putin had him over the knee back in Alaska, and he's kind of responding back to that. So with that in mind, we're seeing in Europe recently we had drones flying over the Copenhagen airport earlier this week. We're still struggling to find out who it was, but obviously some suspicion that it came from Russia. So the temperature on that geopolitical front is heating up in Europe, and I think that's also and that's potentially mean that there will be an even bigger effort to hurt the enabler of this of Russia's war, and the enablers are primarily India and China through the purchase of deeply discounted crude from Russia. And if they manage to get more sanctions in place that not hurt Russia, because that they take everything on the chin, but if they go after the buyers of the crude and fuel products, then perhaps we could see a winter where prices, instead of trading below 60, could potentially trading into the 70s, because it's tightening due to what we're seeing in Russia.
Yeah, it's been wild. And on the natural gas front too, obviously we're hearing a lot of conversations about, cutting oil, cutting gas from Russia. I mean, you're in Europe, and speaking of which, I mean, on that topic, more smoke than fire. Are you hearing anything about this?
Not really. The gas situation in Russia is primarily now a story between Russia and China. Europe is buying a very limited amount of gas. We're getting close to our 90% storage tanks being filled before time. So it looks like we're heading towards the winter with ample supplies. Even though obviously once winter kicks in, we need constant supplies. Then storage level will deplete very quickly. But the LNG capacity, or the LNG export capacity, especially from the US, seems to be revving up, and it's just incredible how such an important commodity, a fuel like natural gas, is still trading as dirt cheap as it is, especially in the US. It's not going to last, but at the same time, it's also. It means it's a very deeply contangoed market, meaning that the spot price is trading much lower than further out, and that means it's just simply impossible to make money on trying to be long natural gas. So rather look at the producers who ultimately will benefit from higher prices.
All right. Great commodity breakdown. Hey, before I let you go, Ole, I mean, let's talk about risk for a second. The MOVE index, which measures bond market volatility, has been surprisingly subdued despite the Fed's recent actions. I mean, is the biggest underappreciated maybe risk of a sudden spike in Treasury volatility that forces a massive deleveraging across all asset classes, including this crowded long position in commodities?
That is the short-term risk. Just like we saw back in April when stock markets collapsed after the beautiful tariff bill was announced. And we obviously, as you rightfully say, we have to remember these a lot of traders in the market, they target volatility. And if volatility spikes, you have to lower the exposure you hold. It doesn't really matter whether it's deeply profitable positions that you really like. You just have to cut across the board, and then you pick up the pieces once the dust settles and volatility comes back down again. That is obviously a risk that we need to be aware of. But at the same time, the bond market, that's really what potentially could make me awake at night. And the reason why I'm never using any calls about rockets or anything when I talk about markets. I'll leave that to others. But what could really send the gold price flying much more than what we've seen already is obviously if the market loses confidence in the Federal Reserve, and with that also in the bond market, and where we get a Turkish-style situation in the US. I don't see that happen. I'm sure there's still a few sane people left in the administration that will make sure that never happens. But obviously, that is a risk that an outlier risk, which initially potentially could send volatility sharply higher, but over time would be a massive support for, again, the tangible assets that are not impacted by or that are away from the fixed income market and from the dollar.
Yeah, interesting. Okay. And some would argue that the underappreciated risk is not a market event, but maybe a political one, a potential de-escalation of major geopolitical conflicts. I know we were watching the same broadcast from the UN yesterday. There's this more rhetoric happening. Obviously, there's these drones, which are close to you. We're watching all these stories, by the way. But I guess my question is, if we were to see a surprise breakthrough, how much of the geopolitical risk premium that's baked into assets like gold and oil would evaporate overnight?
Some of it would, but you also have to remember, if we do get a peaceful solution, then we are looking at a massive reconstruction. Obviously, it could be Ukraine, but it could also be. You could almost hope that it could be in the Gaza Strip. That basically would require a lot of construction. That potentially could send prices higher and rekindle inflation. So even though in the short term there might be an unwinding of a geopolitical risk premium, then the aftermath would be a massive building boom, a massive economic boost, and that potentially could drive inflation higher, and I think underpin prices again. So I don't think that would be the game changer that the market should be too worried about.
Yeah, and all this while we're using more AI and energy too. I guess it's a perfect storm.
Something like that. Yeah, absolutely. Yeah. The long-term trend for commodities in general, I think we are still at the cusp of a super cycle. We had 3 in the last 3 decades. I think we have started the third one, and I think it is the energy transition super cycle, simply because of the energy transition. You can call it green transformation if you like that word, but the energy transition is basically the increased demand for power, which requires massive amount of investment. The reindustrialization of the US and other places, pulling production home. These are all inflationary. These are all requiring increased demand for commodities in general. And underinvestment in the energy market. We just saw recently IEA made a 180 on their outlook for peak demand, peak oil, and now saying that hundreds of billions of dollars are needed for years to come in order to maintain status quo production. That all points to, in my book, to higher prices. So long-term bullish on commodities, not only gold and silver and platinum.
Yeah, and you've been ahead of that curve since we've seen the run up to it too. All right, thanks for joining us. Ole Hansen, of course, joining us from Europe with Saxo Bank. Your insights have been pretty invaluable in piecing together this complex global picture. We appreciate your time.
Thank you very much.
Thanks, Ole. A lot of conflicting signals for investors to navigate here. What do you think is the most important indicator to watch right now? Is it the physical demand signals from China or the policy moves from the U.S. Treasury and the Federal Reserve? Let us know your thoughts in the comments below. Make sure to subscribe for our leading market analysis. For Kitco News and for all of us here, I'm Jeremy Szafron. We'll see you next time.